Okay, next let's take a look at requirement 2. And it says, for direct labor employed in the production of flue decks, compute the rate and efficiency variances. Okay, so the things we need to remember here is that the direct labor standard was $1.40 hours times $12.50 per hour for $17.50 standard cost. They tell us that 35 lab technicians work on the floor. They worked an average of 160 hours at the average rate of $12 per hour. Alright, let's go take a look at the solution now. Okay, now again we can solve this using the column approach. Remember, left side is always actual. We have actual hours times the actual rate. Right side is standard hours times the standard rate. So we know they work $12 per hour, a total cost of $67,200. Well, how did we come up with the 5,600 hours? We took 35 technicians times 160 hours per technician. That was average, right? 5,600. So 5,600 times 12 is 67,200. The standard said $1.40 per hour at a rate of $12.50. Well, we made 3,750 units, so 3,750 units times $1.40 per hour says we should have used 5,250 hours. Then we multiply the 5,250 times the $12.50 per hour standard for 65,625. So now we already know the total variance, which is 1,575 unfavorable, by comparing the 67,200 of actual cost to the 65,625 standard. But we need to compute the middle ground, is what I call it. And how we do that is we move over the actual hours to the middle, and then we move over the standard hours to the middle. So we wind up with actual hours at the standard rate, and if we multiply that, we have 70,000. Compare 70 to 67,200. We see we've got a $2,800 favorable rate variance, and then we compare the 70,000 middle ground to the 65,625 standard hours at standard rate, and we wind up with a $4,375 unfavorable variance. Now if we add the unfavorable to the 2,800 favorable, we wind up with a total variance of $1,565 unfavorable. Okay, now you could also solve this using the alternative method, right? Labor rate variance would be equal to the actual hours times the difference in the rates. So 5,600 hours that we calculate here times the 50 cents different in the rate is $2,800 favorable. The labor efficiency variance is equal to the standard rate times the difference in the hours. So we take the $12.50 standard rate and we compare it to the 5,600 actual versus the 5,250 hour of standard. And since we use more hours, this one's going to be unfavorable. 4,375, which again matches here. 2,800 favorable matches there. And that's how we tackle the direct labor variances here. Alright, now there's an essay question related to Part B, and I've pasted it down below, and I'll read that to you. It says, in the past, the 35 technicians employed in the production of flue decks consisted of 20 senior technicians and 15 assistants. During November, the company experimented with fewer senior technicians and more assistants in order to save costs. And they ask us, would you recommend that the new labor rate be continued? So based on what we see, we had a total variance of $1,575 unfavorable. And the assumption here is that the reason we had the variance is because we changed the mix of the workforce, and we would have operated at standard had we not. So with that assumption in mind, since the variance is unfavorable, the only way we can answer this question is to say no. It looks like the labor mix didn't make sense. Although we were able to decrease the hourly rate by 50 cents, right? $12 versus $12.50. we wound up with a 2800 favorable variance, we also see that the mix of workers wound up with an efficiency variance that was even greater, an unfavorable efficiency variance that was greater than the favorable rate variance. So the net effect looks like this is not a good decision for us. We should probably go back to the old mix if we actually believe that the variance were caused by the change in the mix of the jobs we used. Okay, next we take a look at requirement 3, which says compute the variable overhead rate in efficiency variances. So again, what we need to remember is standard quantity again is 1.4 hours, $3.50 per hour for a total standard cost of $4.90. They told us that total manufacturing overhead is based on direct labor hours, and the manufacturing overhead cost during the month of November were $18,200. Keep in mind, 3,750 good units were produced. So let's go take a look at that solution now. Okay, and now we see the variable overhead solution on the screen. Again, using the column approach, actual times actual on the left, standard times standard on the right. So the actual hours times the actual rate. We really don't know at this point, but we know that the total actual variable cost was $18,200. And by the way, that's typically how it works, because what you're doing is capturing various accounts in a general ledger, and you're not concerned with how many units you used, right? These are all the various spending that took place in the accounts you classify as being variable. So this one might include indirect materials, it might include overtime premium, it could be all kinds of items as well. Electricity may be variable. It depends on your particular situation. Now, the standard says 18,375. Well, we get that by multiplying 5,250 standard hours allowed times $3.50. The $3.50 was given to us. They already came up with a predetermined variable overhead rate that came out to be $3.50 per every direct labor hour. So how do we come up with 5,250 hours? What we do is we take the units produced, 3,750, times the $4 hours per unit. So we've seen this calculation before. So once we know there's 5,250 hours, we multiply it times 350, come up with 18,375. Now all this is the same approach. Well, now that we know that the 350 is what we need in the middle, we move it over here, but we have to compute what the actual hours were. Well, how do we do that? We knew that there was 35 technicians times 160 hours per technician. So this is also a calculation we've seen before. 5,600 hours. And the reason why we're using labor hours is because they apply overhead based on labor hours. 5,600 times 350 gives me 1960. We compare this number to this number, 1,400 favorable variance, this number to that number, 1,225 unfavorable. Add the two together, we get 175 favorable, which you can also just calculate directly by comparing the 18,200 of actual expenses to the 18,375 of standard. Now again, you could calculate this by taking actual overhead times the difference in the rates. So we take 5,600 of actual hours, calculated there, times the difference between 325 and 350. And the 325 is simply the 18,200 divided by the 5,600. So once we get to this calculation in here, we're able to come up with what the actual rate becomes. Okay, and we can work it backwards. Actually, what I meant to say was once we know the hours here, we can take the 18,200 divided by the hours. So to calculate this middle ground helps us if we wanted to use a direct approach. And then on the variable overhead efficiency variance, take the standard rate, in this case 350 per hour, times the difference between the actual hours used and the standard hours. Okay? One last comment here. Both the labor efficiency variance and the variable overhead efficiency variance are computed by comparing actual labor hours to standard labor hours, just like we did with direct labor, because it's applied that way. And therefore, if the labor efficiency variance is unfavorable, then the variable overhead efficiency variance will be unfavorable as well. So we've got a direct relationship going on there.